Good day, everyone, and welcome to the Objective Valuation call. We'll be focusing today on the importance of independent valuation in financial services, and we'll focus on a number of recent changes to regulations that we want to make sure our clients are aware of and working into their valuation work. A couple of housekeeping things before we get into the meat of the presentation. You may ask a question at any time during this live presentation by clicking the Ask a Question button on the top right of your screen, or you can type it in the question window on your screen. We'll do our best to address those as time permits. If we're not able to address the questions as they come in, we'll address them at the end, but we'll make sure to leave plenty of time for questions. If you experience any technical issues during the webinar, please use the tester system link within the question window. As we're getting started, if you want to test your system to ensure an optimal viewing experience, the system will look at your what you've got set up and make sure it works as well as possible. And finally, you'll be able to download the webinar by clicking on the attachment button on the bottom of the screen. As I mentioned at the top, this is David Riedel, the co-founder of Objective Valuation, and we're going to focus today on the importance and important changes in valuation in financial services and how Objective Valuation is including these in the work that we do. First, a little bit of background. Objective Valuation has for the past 11 years been focused on providing valuation assessments for a wide range of institutional, private, and public clients. We have been backed by a very strong team of qualified MBAs, chartered accountants, and CFAs, very wide experience across 100 sectors globally, covering more than 1,000 companies in the past decade. We are truly an independent valuation services provider. We don't provide any services to our clients other than looking at the valuation of the projects and divisions and companies that they're looking at and providing a very objective valuation on that business. We have a very robust methodology and process to ensure high and consistent quality of output and use under the guidance of seasoned professionals and sector experts in all of our sectors. And why is this important? Well, independent valuation is a very critical part of people making the right decisions at the right time and you providing better service to your clients. For a business valuation to be truly unbiased and rational, a third-party professional opinion is the gold standard of what people should be looking for. It avoids conflicts of interest. It avoids reputational damage by discharging fiduciary duties of management. It fulfills the requirements of regulatory compliance, and it allows you to focus on what you're doing and leave the details of staying updated with latest amendments and changes to us, and we can implement those in each and every one of the projects that we work on. This is important because these rules and regulations do tend to change quite frequently, and it's critical that we stay on top of these things to avoid any issues or challenges. So independent valuation has typically been a fairly expensive service for people to take advantage of. But it's something that's very widely needed. So we want to talk about some of the instances where independent valuation is needed. And the reason I want to go through this is I want you to be thinking about the services you provide your clients and how objective valuation can help you do the best job possible in providing service to your clients. Of course, in M&A, it's very important to get a good fairness opinion. It'll help avoid conflicts of interest. It avoids reputational damage for decisions being made that turn out to be wrong. Also, within a company, the employee stock ownership programs really require independent advisors to perform fairness opinions in a lot of cases. This is a very important part of our business and something where we need to make sure that we're doing proper valuation at every step of the process. When the ESOP is initially formed, when there's a third-party transaction, when the sponsor company divests of one of its units or buys another unit, or if there's a tender offer for the purchase of the company stock. These are all times when independent valuations, strong, robust, objective valuations are needed. Clearly, when you're in the process of a business sale, both seller and buyer are going to be assured of a fair and reasonable valuation if an independent valuation has taken place. This is critical in generational change when family businesses are changing hands, being handed down through a family. It's very critical that an objective outsider, not someone who's in the business, not someone who's in the family, and not someone who's too close to that business, provide the objective valuation. Also, a new and upcoming part of our work is crowdfunding. Startup projects need valuations, robust, professional, independent valuations to make their projects bankable and boost investor confidence. It's really a great way to set yourself apart from the multitude of crowdfunding projects that are out there to have a proper valuation and to do a good job in providing a great valuation and a good, robust investment opportunity for people. So one of the things that we spend a lot of time and energy staying on top of are amendments in the laws and changes to laws. And there were recently updates to regulations and the approach made by FASB in April of 2014 in terms of how people think about discontinued operations. So this is very important because as businesses evolve and change, sometimes assets are disposed of by sale or some other process than a sale, and there's been a major change in the way that this is defined. It's critical that when we look at these things, you're talking about a change that represents a strategic shift that has or will have a major effect on an entity's operations and financial results. So there is a differentiation of how these things are defined today, and this was a change as of April of last year, and it has to be put into practice in 2015 for interim periods and for other calendar year entities effective in 2015 and interim periods thereafter. So the new guidance requires that the disposal of a component represents a strategic shift that includes the disposal of a major line of business, a major geographical area, a major equity method investment, or other major parts of an entity's operations and financial results. What's critical to remember is that under the new guidance, the newly acquired business or nonprofit activity must meet all of the held-for-sale criteria to be classified as a held-for-sale on the date of acquisition. The new update also allows companies to have continuing cash flows and significant continuing involvement with operations following the disposal date, while presenting those operations as discontinued in the period of disposal and prior periods. So this can really change the way that your financial statements look and how you're reporting these businesses, because you can still have considerable cash flows, continuing cash flows, and continuing involvement in these businesses while they're being classified in this way. In terms of disclosures, the accounting standards update requires new disclosures for individually significant disposals that do not meet the definition for discontinued operations, and disclosures are required for an entity's continuing involvement with a discontinued operation following the disposal date. So for calendar year public business entities and certain not-for-profit entities, this guidance is effective in 2015 and interim periods within that year. For other calendar year entities, it's effective in 2015 and interim periods thereafter. So if this is something that's very real time, we'd be happy to spend the time to walk through the implications of this for you and your clients, and something that Objective Valuation is spending a lot of time on these days to help clients stay on top of. So we're also going to talk a little bit today about the measurement of goodwill. FASB has added an accounting alternative for the measurement of goodwill, and allows companies that don't meet the very specific definition of a public business entity to elect to amortize goodwill acquired in a business combination and to perform one-step impairment test beginning with 2013 statements. So this is something that you may have seen in 2014, but it's going to become a bigger part of our business going forward. Amortizing goodwill, which reduces the risk of impairment over time and the need to perform a full impairment analysis, is now extended to private companies. By being able to do a one-step impairment test, this reduces the cost and complexity as well as the difficulty of doing these impairments over time, and it can be done. You can choose to do it when there's a triggering event rather than on an annual basis. So you do have the option to amortize goodwill over a period shorter than 10 years. Private companies are no longer required to identify reporting units for allocation of assets and liabilities for impairment testing, which is a critical change in the way that we're going to be dealing with these disposals going forward. So we've covered a lot of ground there. Obviously, a lot of things for people to think about in terms of valuation of their businesses and the businesses you run across in your operations. This is a time for people to really think about how valuation can play a part in your business and really help your clients do a better job of asset disposals, proper reporting, avoid regulatory risks, and really set themselves above the others for the quality of their reporting. I've had a couple of questions come in, and I want to address some of those now. One of them is, how do you see the role of valuation services in managing generational changes in business? Well, this is very critical because a lot of companies have been built over time by families, and the members of that family have a very long history with the valuation of the business, and they may not be the best people to estimate the value of the business. So we need to bring a new set of eyes, a clear set of eyes to this valuation, and really show people that there are different ways to look at the valuation, but a professional way to do it from the outside. So that the generational change in business is a big part of what we do. What's the best way to engage with objective valuation? And what is different about our approach to providing valuation services? We think it's critical that people remember to use valuation services when that's relevant. They start to use it more often in their businesses because it's something where people are very wary of using these very expensive services that have been hard to access and difficult to implement. But now we want to offer a better priced service, a high value service, a better priced service to really help people understand the importance of changes in goodwill amortization and changes in the value of their business going forward. I'm getting a couple of other questions here. What is a triggering event? Anything that impacts the fundamental value of the business. A change of control can be a triggering event, of course. And I'm getting another question now about the method of goodwill, how it should be amortized. Whatever is the appropriate way for amortization to take place before the change, that would be the appropriate one now, but it can take place for a different basket of companies, and it can take place over a changed amount of time. Polling for other questions, if there's other questions out there now. Well, we've covered a lot of ground here today. I want to thank everyone for their attention and their time today. Please do reach out to us if there's other questions that you guys have and other ways that you want to think about how you can use objective valuation in our businesses. We want to be here to help. We want to be a partner with you in making your business as successful as possible. So please call us at 415-413-3532 or email us, and we'd love to find a way to partner with you. Thank you very much for your time.